Hello and welcome. My name is Melissa Glasso, and today we're going to talk about ASU 2023-09, which is expected to be the last ASU of 2023. Now, FASB can surprise us. They have done it in the past, but based on their technical calendar, it looks like this one might be the last for 2023. So we hit 9 this year, which is more than last year, but definitely on the lower end of what we have seen historically, with some years having in the 20s in terms of the number of ASUs. So this is a little bit of a lighter year, and many of the ASUs are very niche. We've talked recently about cryptocurrency in ASU 2023-08. We've talked about segment reporting impact only public entities this year, and so as a result, we may or may not see as many changes for all organizations. But one that is going to impact a lot of organizations is ASU 2023-09. So this was issued in December of 2023. And it is part of the invitation to comment as well. So a lot of the feedback from the invitation to comment around the agenda consultation, investors really were looking for more disaggregation of income statement information. Now, this is going to focus solely on improvements to income tax disclosures, a portion of the income statement. There's a separate project called DICE, disaggregation of income statement expenses, and that standard is in its proposal phase right now, so we don't expect a final standard till next year, and that standard only impacts public companies. This standard impacts public and private, and so over the last year, I've done a lot of discussion, and especially in my year-end A&A classes. We usually covered this in my FASB updates. If firms had, say, a 4-hour FASB update or 3-hour FASB update, a lot of time we would cover what was effective this year, what was coming down the pike, and then a lot of times we cover the big exposure drafts, and this is one of the bigger exposure drafts that we would cover in our longer courses. So it is nice to see that it has come out. However, we have taught our last class of 2023 already, so not in time for any of our classes for 2023, but it will be definitely a big part of our 2024 FASB classes as we move forward. But let's talk a little bit about ASU 2023-09, which is, again, income tax disclosures. So investors, lenders, creditors have given feedback to the FASB that there is a lot of potential risk with respect to income taxes. Obviously, if you have a concentration in a particular state or in a particular jurisdiction, then if the tax rates are increasing, that can have obviously a pretty big impact on cash flow as well as obviously on the income statement itself. And so they wanted to have more understanding of the jurisdictions that entities were paying taxes into. So this standard, as I said, impacts PBEs, public business entities, non-PBEs are private entities, including not-for-profit organizations. That's something that people tend to forget in this. So I don't think nonprofits and then income taxes, but unrelated business income taxes, or UBIT, are included in here. So I always do like to remind people of that, especially when I'm teaching our nonprofit sections. And then they did make a change to terminology here as well. So let's take a look at what's going on in this ASU. First off, again, there's some of it that only impacts public business entities, those entities that file with the SEC or one of the other 4 different reasons why you could be a public business entity. They are on an annual basis going to disclose the specific categories in their rate reconciliation. So the FASB provides a little bit more disaggregation around the specific categories that they do want in that rate reconciliation. And it would require them to provide additional information for reconciling items that meet a quantitative threshold if the effect of those reconciling items is equal to or greater than a very low threshold, 5% of the amount computed by multiplying pre-tax income or loss by the applicable statutory income tax rate. And so as we look at this, when we're looking at the rate reconciliation, we're going to have more disaggregation in the reconciliation itself, but then additional information for those reconciling items that exceed that 5%. So again, this is for public entities, obviously a huge impact. In addition, for the state and local category, they are required to provide a qualitative description of the states and local jurisdictions that make up the majority, which is obviously greater than 50%, of the effective state and local income tax category. And so again, in this scenario, they would provide a qualitative description of, okay, which states and jurisdictions, again, because in some states like New York, you don't just pay New York State, you have a New York, you have New York City in addition to that. That has an income tax requirement. So they do want the states and local jurisdictions in there. And then you would provide an explanation, if not evident, of the individual reconciling items disclosed, such as the nature, the effect, and the underlying causes of the reconciling items and the judgment used in categorizing and reconciling those items. So again, for public business entities, they're going to have a little bit more requirements here. For non-public entities, for non-public business entities, it does require a qualitative disclosure about the specific categories of reconciling items and individual jurisdictions that will result in a significant difference between the statutory tax rate and the effective tax rate. This is a little bit of a cleanup job on the extant requirements there, but they do not have the same, category requirements that the public business entities have. All right, so that is the least controversial of all of them. Let's get into the more controversial, which is the all entities, public, private, nonprofit, all entities on an annual basis are going to be required to report the amount of income taxes paid, net of any refunds, disaggregated by federal, national, state, and foreign taxes. So we are going to look at it on a cash flow basis. We're going to have a disclosure of the amount of income taxes paid, again, net of any refunds, disaggregated out. And then this is usually where private companies, and I will tell you the PCC, the Private Company Council, did provide some pushback here to the FASB that this would be a very big burden on smaller entities. And I get a lot of that feedback in my classes, particularly around entities who may not have the timing of the financial statement preparation compared to the timing of the income taxes. Obviously, there's obviously differences in what periods reported from a cash flow perspective versus what's shown in the income statement. And so you would provide the amount of income taxes paid, again, still net of the refunds received, disaggregated by individual jurisdictions in which income taxes paid, net of refunds received, is equal to or greater than 5% of income taxes paid, net of obviously the refunds received. Now, this is very easy to hit. So many of you know, I teach CPE all over the country. We have firms that we partner with from California to Florida, all the way up to Vermont, and pretty much everywhere in between. And we are very grateful for all of our amazing clients, but that does require GLS to file taxes in many, many states every year. And we are grateful to our wonderful CPA who handles all of those crazy income tax returns in all of those jurisdictions. And so in this scenario, this can be pretty easy to get 5%, depending on the number of jurisdictions that you're filing in. So again, the standard is issued, it is final, this is the requirement, and so on the cash side of the house, it is that disaggregation. But we're not done because there is also an expense side of the house. So for all entities, public, private, nonprofit, we're going to have to present income or loss from continuing operations before income tax expense or benefit, disaggregated between domestic and foreign, and then income tax expense or benefit from continuing operations disaggregated by federal, state, and foreign. So again, users really wanted to know where our taxes were coming from. They didn't want just a one line item of income tax expense. They wanted this disaggregation, and FASB met their requirements. Now, I do want to just mention that there were two removals. It eliminates the requirement for all entities to disclose the nature and estimate of the range of the reasonably possible change in the unrecognized tax benefit balance in the next 12 months, or make a statement that they could not do that. Again, that's a lot of forward-looking information there. And then they also remove the requirement to disclose the cumulative amount of tax of each type of temporary difference when a deferred tax liability is not recognized because of the exception to comprehensive recognition of deferred taxes related to subsidiaries and corporate joint ventures. So there were two removals, but many people point out there were a lot of additions in the standard. Last but not least, I want to talk about terminology because it does change the terminology to public business entity. When they introduced the term public business entity back in 2012, or 2013, they issued a public business entity in 2013-12, and they said when we start using it, which was ASU 2014-02, then we would use it going forward, but they never went back and fixed it. So topic 740, which is income taxes, still used the term public entity. So while they were in there making these other changes, they replaced the term public entity with the term public business entities as just part of their cleanup process. So when are we going to have to do this? Well, for public business entities, it's for annual periods beginning after December 15, 2024, which would be calendar 25, fiscal 26. And for other than PBEs, or private companies or nonprofits, for annual periods beginning after December 15th of 2025, which would be calendar 26, fiscal 27. So we have some time to start taking a look at this, talking to our tax people, and make sure that we have this. Early adoption is permitted so long as you hadn't issued those financial statements, and it is provided on a prospective basis for this change. However, if you choose, you can use a retrospective. All right, guys, so that's a wrap on the hopefully last ASU of 2023. So it is December of 2023. So I want to wish you all a very happy holidays, happy new year, and good luck as you get into your upcoming busy season and closing up the books. And we look forward to seeing you on a future Nano Learning. Have a great day, guys. Bye-bye.